Hi, my name is Jeff Witz. I'm the Educational Program Director and a Certified Financial Planner at Medicus Asset Advisors. Quick background on Medicus. We've been educating and advising physicians for over 30 years. Over 90% of our clients are physicians, and we manage over $1 billion in physician assets, so we feel like we're particularly tuned in to the financial needs of physicians. Now, before we get into today's presentation, some quick disclaimers we're required to give. We are affiliated with a broker-dealer, Osdale Financial Partners. That allows us to buy and sell securities and insurance products for our clients, but really that makes up a very small part of what we do. Only about 1% of our revenue comes through those sources. The other 99% of our revenue comes from providing wealth management advice and recommendations to our clients, and to be able to do that, we are registered with the Securities and Exchange Commission. So today's topic is disability insurance. Disability insurance is a type of insurance that really every physician needs. At age 35, you have a 50% chance of suffering a disability 3 months or longer between now and when you reach age 65. This could mean not only losing millions of dollars in income, but a lost ability to pay a mortgage or your rent, save for financial goals like retirement or your kids' college educations, or just generally live the lifestyle you need. Disability insurance provides financial cover in the event you become sick or disabled and are unable to work for an extended period of time. Today we'll look at what disability insurance is, why it's important to have, and how you can start exploring getting coverage. Let's start with why disability insurance is important. I'd like to start this section off with a question. What is your most valuable asset? Here's a hint. What if I told you that this asset can earn over $10 million over its working lifetime? Yes, it's you and your ability to practice and earn income in your specialty area. So what would happen if you became sick or disabled and were unable to work for an extended period of time? Would you still be able to afford the big new mortgage you just took out? Would you still be able to save for your retirement? Would you still be able to save for your kids' college educations? Would you still be able to pay off your student loans? Just because you're no longer able to practice medicine doesn't mean your student loans suddenly go away. This is where disability insurance comes into play. Disability insurance ensures that some or all of the financial goals that you have can still be met. I'm sure many of you have car insurance or health insurance. Why do you have these things? It's to protect yourself from a significant financial loss in the event that something negative happens. So doesn't it make sense to protect your most valuable asset? Again, an asset that can produce millions of dollars of income over its working lifetime? We certainly think so. When considering disability coverage, here are a few things to pay attention to. First is the elimination period. This is the amount of time you have to be sick or disabled and not working before the policy will start paying out a benefit. Common elimination periods are 90 days, 180 days, and 360 days. You usually want to try and align the elimination period with the size of your emergency fund. For example, if you have a 3-month emergency fund, then a 90-day elimination period makes sense. 6-month emergency fund, then a 180-day elimination period makes sense. The idea being there, once you have exhausted your emergency fund, the disability insurance kicks in so that you don't have any gaps in your income. The benefit period is how long the policy will pay out the benefit. We always recommend a physician get a benefit period to their full retirement age of 65 or 67. The idea there being, if you became disabled the week after getting the policy will pay out the monthly benefit amount each month until you reach normal retirement age. This should allow you to still continue a certain lifestyle and save for your most important financial goals. The monthly benefit amount is pretty straightforward. This is the amount of money the policy will pay out each month. This amount is likely to vary amongst your peers. As we'll discuss in a bit, your income and your employer benefits will play a role in how much coverage you can get. With salaries and benefit packages likely to vary, each physician is likely to require different amounts of coverage. Next is non-cancelable and guaranteed renewable. This means that the insurance company can never cancel the policy on you as long as you continue to pay your premiums. Why is this important? Well, let's say you're approved for a policy and then a few years later are diagnosed with a serious health condition. Now the insurance company probably prefers not to cover you anymore. With this feature, they must continue covering you as long as you continue to pay your premiums. Next is level premium. This means that the premium you pay will never increase on you. Compare this to a graded premium. Graded premiums start low, sometimes very low, but increase every year. Having reviewed these policies, Typically, if you plan on keeping the policy past age 50 to 53, which most physicians do, you'll end up paying significantly more over the lifetime of the policy in a graded premium compared to a level premium. Next, the most important thing to pay attention to when choosing a disability policy is the definition of disability. We always recommend a physician get a true own occupation definition of disability. This is a specialty-specific definition. This means if you are unable to work in your specialty, but are still able to work in some other capacity, the policy will still pay out the full benefit. Compare that with just an own occupation, so not true own occupation, just own occupation, or an any occupation definition. These say that if you are able to earn income in some other job, the income you earn at that job will either reduce the benefit the policy pays out or completely eliminate the policy paying out a benefit. True own occupation ensures you receive the benefit no matter what your work circumstances are after a disability. Finally, mental and nervous disability coverage. We recommend physicians try and get unlimited coverage for mental and nervous disabilities. Unfortunate statistic I learned a few years ago is that mental and nervous disability claims are the #1 claims made by physicians on their disability policies. You work in stressful environments, long hours. I'm sure you've heard all the statistics about physician burnout. So getting unlimited mental and nervous disability coverage is desirable. Some policies will limit coverage to 24 months if not hospitalized for that condition. All the features described on the previous slide are typically included in the base premium you pay. You can also add features called riders for added premium. Riders that we think are important for physicians to have include the following. The residual and recovery benefit riders work very similarly to one another. The residual disability rider works like this. Let's say you get into a car accident, and due to the injury sustained in that car accident, you're only able to work 1 or 2 days a week. You can activate your residual benefit rider to pay out a portion of your monthly benefit to assist with the lost income from not working those other 3 or 4 days. Technically, you can activate this rider if you have suffered a 20% or more loss of income due to a disability. It is not an exact 1-to-1, but the best way to think about it is, if you've lost 50% of your income, the policy will pay out 50% of the monthly benefit amount. The recovery rider works very similarly. The way this rider works is, let's say you had a more significant disability and were out of the workforce for a couple of years. But then due to treatment, medication, or physical therapy, you start becoming healthy enough to go back to work. But again, you can only physically go back to work maybe 1 or 2 days a week. You can activate this rider to pay out a portion of the benefit to make up for the 3 or 4 days a week that you were unable to work. Why are these riders important? Without these riders, if you were able to work 1 day a week, the insurance company could say you're no longer disabled and will stop paying out the benefits. These riders allow you to ease yourself back into the workforce without fear of completely losing your disability benefit. Next is the cost of living adjustment rider. This rider increases the benefit you are receiving each year so that the benefit is keeping up with inflation. Again, inflation is the idea that goods and services get more expensive over time. So what $5,000 can purchase today is going to be a lot more than it can purchase 10 years from now or 20 years from now. This rider increases your benefit each year to keep up with inflation so that you're not losing purchasing power over time. Next is the benefit increase rider. This rider allows you to increase your monthly benefit without having to go through medical underwriting again if you are now earning significantly more than when you first took out the policy. This rider is most commonly used when you have left your residency or fellowship program and are now an attending physician. Finally, the student loan rider, it's not common for physicians to get, but I wanted you to be aware that it is an option. This rider says that if you become disabled and are receiving a disability benefit, this rider will pay out a lump sum towards your student loans. This rider should really be considered if you plan on refinancing your loans, where getting on an income-based plan is no longer going to be an option. How much disability insurance should a physician have? It is typically recommended that a physician have at least 60% of their pre-disability income protected by disability insurance. For example, and to keep the math easy on me, if you earn $100,000 per year, then getting disability insurance that will protect up to $60,000 is the minimum recommendation. The 60% mark is the combined amount between what an employer provides and what the physician has purchased themselves. As a reminder, 60% is the minimum coverage we recommend. What we really recommend is that physicians get as much disability coverage as they can. Many supplemental disability insurance companies will insure up to a maximum of 70 to 75% of your pre-disability income. How much disability coverage can a physician get? A resident or fellow can get up to $5,000 per month of benefit. This is regardless of their current employer-provided coverage and their future employer's coverage. Some residents and fellows within 6 months of starting their positions as an attending can apply for between $6,500 and $7,500 of coverage. These amounts can often exceed 100% of their income as a resident or fellow. As mentioned before, the maximum coverage an attending physician is typically allowed to get is 70 to 75% of your pre-disability income. This amount is combined between any employer-provided amount and any supplemental coverage a physician has purchased themselves. Why won't they allow you to insure up to 100% of your pre-disability income? Well, if you were not working due to a disability and still earning 100% of your income, pre-disability income, if you became healthy enough to return to work, you don't have much incentive to do so. The insurance companies recognize this and think an extra 30 to 40% of earning potential is enough to incentivize someone to get back into the workforce who's healthy enough to do so. The maximum amount of coverage offered by supplemental disability companies will be impacted by how much coverage your employer provides. For example, many employer-provided policies will have language that says, we will cover 60% of your pre-disability income up to a monthly maximum benefit of $10,000. Many physicians make significantly more than $10,000 a month. This coverage will impact how much supplemental coverage you can get. We'll cover a full example on this later. When should a physician apply for disability insurance? As soon as possible. Disability insurance, like life insurance, is priced based off of the applicant's age. The younger you are when you get a policy, the lower the locked-in premium will be. Health also plays a role in getting coverage, as certain health concerns could cause the insurance company to reject you altogether for coverage or approve you with an exclusion. An exclusion is when you are approved for coverage, but not every disability is covered. For example, if you tore the ACL in your left knee in the past, the insurance company could say that they will cover you, but will not cover any disability related to the left knee. The younger you are when you apply, the less red flags in your medical history that could lead to an exclusion or an outright rejection. We would highly encourage women who plan to become pregnant to get disability insurance before they do so. We unfortunately have had a number of women clients rejected for coverage or had all future pregnancies excluded due to what we considered minor complications that arose during pregnancy. Highly encourage you to get coverage before you become pregnant. If you are a resident or fellow or about to become one, you should consider getting a policy as soon as possible. During your residency and fellowship, you are at the greatest financial risk of a long-term disability than at any other time in your career. During your training, you typically only have a modest policy provided by your program. Usually it covers up to $2,500 or $3,000 per month of protection. You don't yet have the big policy your attending position is likely to provide, where you may be covered up to $10,000, $15,000, or $20,000 per month. So if you were to get a long-term disability in your training, you may only get $2,500 or $3,000 per month for the rest of your working years. Will those amounts be enough to accomplish all the goals you have for yourself? Probably not. So you can purchase a supplemental policy up to $5,000 per month of additional coverage to stack on top of the policy your program provides. So now you have much more coverage in the event something happens. Is $8,000 per month of disability income enough to still accomplish all of your goals? Probably not, but it'll get you much closer than $3,000 per month. How much does a disability policy cost? Unfortunately, disability insurance can be expensive. As an attending, you could be looking at paying hundreds of dollars a month in premiums, but it is worth the added expense. Again, you are protecting millions of dollars of earning potential. Disability insurance is typically significantly more expensive for women than it is for men. Why? Complications that can arise during pregnancy. On the flip side, life insurance is more expensive for men than it is for women because men typically die at a younger age. Residents and fellows should highly consider getting a policy while they're still in their training. Many companies offer up to a 20% discount on the premiums if you get a policy while still in your program. The insurance companies know that if they can get you into a policy now, you are likely to keep that policy for the rest of your career. So to incentivize you to get a policy with them, they add significant discounts. So another reason to get a policy as soon as possible. So let's put it all together and take a look at what a typical disability scenario could look like. Assume you earn $400,000 per year. This comes out to $33,333 per month pre-tax, or approximately $22,666 after tax. 60% of this monthly amount, the minimum recommended coverage you should have, is $13,600. Your employer provides coverage equal to 60% of your salary up to a maximum monthly benefit of $10,000 a month. At your income, you hit the $10,000 maximum. Now, it is important to know anytime your employer pays the premiums on your disability policy, the benefit you receive if disabled is taxable to you. You must include it in your income and pay income taxes on it. So the amount you actually receive after tax from the employer policy is usually much lower. In this example, we assumed a 32% tax rate, so the after-tax benefit received from your employer policy is $6,800. If your minimum recommended coverage is $13,600 and your employer provides an after-tax benefit equal to $6,800, then you have a disability shortage of at least an additional $6,800. This is the minimum amount you should consider purchasing from a supplemental disability company. If you want to explore getting supplemental disability insurance, we can assist you. We are not affiliated with any of the other disability insurance companies, so we can shop your information around to most of the major disability companies who focus on providing coverage to physicians. We typically put the 3 or 4 most competitively priced policies that have all the features we think are important for physicians into a comparison spreadsheet and go through them with you. To get quotes, we need the following information: date of birth, sex, state of residency, income. Your income is not necessary if you are a resident or fellow or about to become one. Any health concerns, any employer coverage. Again, this information is not necessary if you are a resident or fellow. Finally, the name of any residency or fellowship program you are in if you are still in your training. With this information, we can get you quotes. Once quotes are assembled, what is provided to the physician? We create a comparison spreadsheet that shows most of the features included in the policy, as well as the riders. Let's take a look at what this looks like. Here are the quotes for a 27-year-old woman entering residency who's seeking disability coverage. As you can see, these quotes have all the features we discussed earlier. A 90-day elimination period, benefit period to age 65, it's non-cancelable and guaranteed renewable, it's level premium, it's a true own occupation policy, has unlimited coverage for mental and nervous disability conditions, has a residual and recovery benefit rider, a COLA or cost of living adjustment rider, and guaranteed insurability rider, or sometimes known as the benefit update rider. In this case, Principal had the lowest premiums. For $2,500 of a monthly benefit, the premium is about $93 per month. For the maximum $5,000 of benefit, the premium is about $186 per month. On this page, you can see a 27-year-old man applying for the maximum $5,000 monthly benefit. With all the same features as the previous comparison, you can see this premium is lower at about $123 per month. In this example, we have a 38-year-old woman physician who is in need of more disability coverage. As you can see, for approximately $13,000 of monthly benefit amount, the premium jumps up significantly to around $760 to $860 per month. We show this to really emphasize the cost-saving benefit to getting a policy the younger you are. The longer you wait, the price can increase very significantly. For a 32-year-old man seeking additional coverage around $16,500 of monthly benefit amount, you can see the premiums are about $550 per month. Thank you for listening. If you have additional questions or want to explore getting disability quotes, please contact us. Again, my name is Jeff Witz. I can be reached at 312-419-3733. Can also be emailed at my last name Witz, W-I-T-Z, @medicus.com. Again, thank you for listening, and we hope to hear from you soon.